Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show, the second to last weekend show of 2025. Corey and Shad here, your hosts again for this weekend's edition. And on this weekend show, we're going to be taking more of a step back, talking to a couple generalists, getting their kind of recap of 2025, outlook into 2026, whether that be near term or longer term, and really trying to, again, make sense of where these markets are going, because it's been another good year for the broad averages, but there's been a lot for us to talk about throughout the year in terms of what's been leading these markets, a rotation of money, and quite frankly, there's still, I think, a pessimistic attitude out there, sentiment towards these markets. So a lot for us to get into this weekend show, and just as a reminder, please join us on YouTube. Just search The KE Report. Subscribe to our channel. Like and listen to the videos. Also, check us out on Twitter or X and Substack. Just search, again, The KE Report. And you can also find all our daily editorials and company updates on our website, kereport.com. Let's get into this weekend show, kicking off with Dana Lyons. Dana is a fund manager and editor of the Lyons Share Pro website. We talk with Dana about every 2 weeks, and we're going to be wrapping up the year with him in these first two segments of the weekend show. So Dana, let's just start off with a broad comment here. You're very much a technical trader. You stick to what your models are telling you about broad averages and individual areas of the market. Just curious, do you care at all, or do your models care at all about the time of the year that we're in, or even more so, how these markets end and how you compare it to past years?
Yeah, thanks, Corey. Generally not, we don't put a lot of stock, no pun intended, into that, because we have our, as you mentioned, we have our quantitative models that a lot of that, the inputs come from various internal breadth measures, some sentiment smart dumb money inputs, but a lot of broad market types of measurements just to gauge what the overall market is doing right now. Are most stocks going up, most stocks going down? So we don't have any seasonality components that directly feed into those models. So I would say there are no direct inputs from seasonality that really direct our investing. But there are, some strategies and some strategic track records from seasonality models and cycle models that are pretty compelling when looking back. Not that we use them, but just perusing their track records, it's pretty compelling. So I would say we use those types of seasonality or a cycle types of analyses as more or less a gentle headwind or tailwind for whatever our posture is anyway. So entering the second half of December, for example, it's generally a pretty bullish or positive seasonal period of the year. So our models right now are bullish. So combining that with a positive seasonality here going into the end of the year, I would say maybe that allows us to maybe step on the gas a little bit more aggressively than we generally would. But again, that's only a slight or a minor adjustment based on seasonality that we would make.
Well, Dana, just to piggyback on seasonality and sentiment, I asked you this off mic, but I think it'd be good for the benefit of our listeners just to hear your answer. I was asking about in January, a lot of people reposition, or sometimes the end of the year, they reposition their weightings or they allocate things differently. They do some window dressing if they're an institution to close the year a certain way, but then they reposition in the new year. Do you watch for any of that under the surface as far as different sectors increasing in weight or maybe getting momentum going or relative strength to certain sectors that may change as we enter the first quarter of next year?
There are so many machinations related to what you mentioned and other reasons that it's really hard to anticipate, what types of waves are going to be going on underneath the surface, not related to whatever's happening in the market organically, what sort of exogenous forces are going to be exerted on the market due to tax purposes, rebalancing, that type of thing. So we don't really, again, we'll stick to our quantitative models in terms of our investment posture and don't really try to game any of those year end, year beginning types of strategies. I will say January, like you mentioned, January tends to be a kind of a tricky or an odd month in that you'll see it kind of more so than any other month, not kind of correlated to what was going on beforehand or maybe what comes afterwards based on what happens in January in our studies that we have seen. So January can be a little bit quirky. The best we can do is kind of ignore the quirkiness and stick to our models and stick to our bread and butter that have the models that have served us so well, for decades and decades, but just cognizant of the fact that there might be some machinations, like I said, going on under the surface related to the year end or new year, the turning of the new year that might distort things or cause market action that raises your eyebrows, but just know that that might have something to do with, the new year stuff and not necessarily pertaining to something organic, an organic trend emerging within the market in general.
So, Dana, if we step maybe a little aside from your models, I'm curious about longer term trends or cycles, where we might be, what you might follow as we're heading into 2026 to give us more of a not so short term, but longer term outlook.
Yeah, so cycle, probably the most consistent cycle might be like the 4-year cycle. You could call it the presidential cycle. They're all, intertwined. I would say interesting. There are a couple of interesting junctures within that cycle. One would be the second year of the presidential term entering, approaching the midterms next fall. Generally the first quarter, so the first quarter of 2026, tends to be a pretty bullish or positive quarter historically, and then you get into the second and third quarter of the second year, which would be next year, and those are the only back-to-back historically negative quarters within the 4-year cycle, on average. So I would say if markets, resort to that historical trend, we might see a nice first quarter to start 2026 and then get into some headwinds over the subsequent, second and third quarter if history is to be any gauge. And looking at maybe kind of how our models are setting up, kind of how the broad market is setting up right now. To us, it is set up for further upside here, and then maybe some sort of a exhaustive type of topping scenario, whether it's a long-term top, whether it's just an intermediate term top that leads into that midterm type of struggle remains to be seen. But I would say generally the way things are set up now, I could foresee that type of market action, unfolding over the next several quarters.
Well, Dana, let's dial it back down to maybe more the near term, medium term outlook that your models have. We've seen the markets broaden out. We've seen more participation from the small caps and the mid caps. It's not just the mega cap tech stocks leading the charge. Anything there changing in your models as far as a broader participation?
Not at all. We had an interesting, I would say, fourth quarter here. Towards the end of October, our models started weakening, even with the major averages continuing to hit new highs. We got a sell signal in early to mid-November, our first sell signal since mid-December of last year, which was interesting and indicative of a kind of a broad weakening or deterioration of the foundation of the rally below the surface, the broad market. And so that led to, the volatility, the corrective action we saw throughout the rest of November up until about Thanksgiving. Since then, it's been kind of interesting action. Whereas you had, large cap growth and tech leading the way, it's been the relative strength leader for a long time. we've kind of flip-flopped since that bottom in late November. It's been, as you mentioned, the broad market reemerging, small caps reemerging, that broader market adopting the new relative strength, even as kind of the tech and large cap growth and NASDAQ, that type of sector has kind of lost its leadership mantle, is now really kind of the laggard in the market. And I think probably got overowned, probably got a little bit too frothy in terms of sentiment there. And you've seen some rotation, as Corey has mentioned, from that large cap tech into kind of the broader sector. And that is, from our perspective and our modeling perspective, that is a pretty healthy or constructive type of development. And then we see a pretty constructive setup here for further upside in the broad market.
Now, does this have anything to do with the potential environment where we could see lower rates? The bond market has, I guess, rebounded a little, or has sold off a little bit just this month as rates have rebounded. But all we're hearing about is potentially rate cuts next year when Trump gets his guy at the Fed. What are you seeing in the markets, and does it play into the bigger picture of potentially lower rates, and that's why small caps are doing well?
Yeah, that's the argument. And I would say, us, we seldom ask why, because as investment managers, we don't really need to know why something is happening, just as long as we know what is happening. So that would certainly play into the narrative of the small cap or the broad market reemerging in a leadership role, which we are starting to see. And that would, historically from the narrative, that would play into that kind of lower rates narrative. So maybe that tells us what's going to happen down the pike. But again, like I said, we really don't care why something is happening. That usually plays out down the road. You see a move like maybe a year ago when we saw the deterioration in the broader market, the small caps and the internals of the market, that after a brief rebound into January, February of last year, especially in the large caps, you saw the big correction correlated with the tariff news headlines into the spring. And you never know what's coming down the pike, what's causing the market action. There's always a reason ascribed for that later on. So why did the market deteriorate at the end of 24? Maybe they anticipated, the tariff stuff coming, and the correction is going to occur there. You don't know. But again, all we care about is reading the tea leaves at what is happening. And right now it's kind of an opposite, kind of a flip-flop scenario from a year ago when the broader market was starting to deteriorate. Now it's really kind of, as you mentioned, starting to reemerge in a leadership role.
Well, Dana, as we look at that broader market, are there any subsectors within it that really have your attention for relative strength? There's a big gamut out there: healthcare, financials, utilities, consumer staples, consumer discretionary, commodities. Anything really ringing your bell right now?
Well, you mentioned a good handful of them. Consumer discretionary is starting to emerge. Industrials look great. Financials look great in terms of some of the broader sectors. Healthcare still looks great. Healthcare is something that if you don't have an allocation to right now, we saw a nice breakout over the last month or so, and you've seen a bit of a pullback or give back in that. Might be setting up for a nice buying opportunity around here. Biotech as well. So there's really no shortage again, and that's what we like to see. We like to see some good broad swath of potential leadership groups in order to signify, a stronger, more durable type of a bull market, rather than, a narrow type of a rally that we saw, really, especially leading into that August 24 kind of correction, where you saw it just ended up being like the Mag-7, and that was not enough to prop up the market. So yes, I saw that correction, but now we're seeing a pretty broad selection of potential relative strength investment groups right now.
Dana, I'm curious your thought on that whole buy the dip mentality, where this year was another year where when we saw dips, mostly news event worthy, They were bought back extremely quickly. That April drop, that one, I guess, lasted a little while. That was about a month, just over a month long, and then really ended with a bang. But again, it got bought back quickly. Then we had another dip in November, which was then bought back very quickly. Has this just been another year that reaffirms to people that buy the dip? Whenever you see a dip, you might as well jump in because it just comes roaring back.
Yeah, and that plays into maybe the longer term cycle factors where, okay, we're still in a kind of a secular bull market. We're not into the phase where, okay, we want to be selling strength for the next couple of years, for example. So we're still in a bull market. So any major corrective action that we get, you want to be buying, certainly buying the dip. And, the March, April move I would characterize that as a pretty serious correction given the losses that we sustained. So you got in trouble trying to buy that dip, whereas just recently it was a little bit different. We had a more really moderate sell-off in November, especially considering that our models turned negative and then flip-flop back positive pretty quickly. But typically when our models turn negative, you get more of a drawn out correction like we did back in the spring. But it was interesting to us to see things rebound so quickly. And I guess one factor that has kind of played into that this year is kind of I think maybe the proliferation in the number of hedging instruments now. It seems that especially back in March, April, you saw right at the bottom, you saw so much hedging activities and so much bearish sentiment all of a sudden after they had tried to buy the dip all the way down. Interestingly, in November, you saw a really good uptick in hedging activity and bearishness despite the more moderate pullback. And I think that fed into really the strong rebound that we've seen out of that. So I think that one thing that the proliferation of those new hedging instruments give us is more data from really a smart dumb money kind of positioning, or really it's the same thing as saying, short-term sentiment measures. There's more data now that we can use to measure kind of short-term investor sentiment. And that obviously the more data we have, the more helpful certainly it could be, at least at extremes, like we saw in late November. I would say right now we're more neutral. So sentiment is very unhelpful at neutral points. And I would say that's where we're at now. But when you get those extremes, it can be very helpful.
Yeah, there's definitely a lot more people doing 0-day options, inverse ETFs, leveraged inverse ETFs. And so when you can look at some of the patterns in those, you do pick up on the money flows. Well, Dana, we got to ask you about the commodity sector. A lot of our listeners in the resource sector. Been a bang up year for the precious metals, even the base metals and critical minerals. Any thoughts? Let's maybe start with the precious metals. What do you think of gold and silver, where they're at closing the year?
Yeah, still love the precious metals. We had that kind of blow off into, I guess, October, and then we said, well, probably going to be range bound for a while. Silver didn't last that long in that range bound trade before breaking out, and that certainly was constructive. Same thing with copper. Gold now knocking on the door of those former highs, so probably eventually that breaks out as well. Same thing with the miners. So anything hitting all-time highs, you can't be too bearish on those. So we'll keep riding those trends, as long as they last. As far as the rest of the commodity space, I don't see a whole lot, but that's fine. Precious metals and the miners, they're giving us enough action right there, and have really fortified our portfolio all year. So that's been probably, I would say, obviously, probably the best trend of the year outside of maybe some of the market timing signals we've had in the broad market. It's just been the steady strength of precious metals and the miners.
Yeah, it really has been. They've just been outperforming the markets all year and quite a bit. So, just curious from a more generalist standpoint here, Dana, in terms of your exposure to the precious metals, how would you rank it throughout your history? Is this the most exposed you've been to it? Is this one of the best precious metals markets you've seen? Could you still build up exposure to it? Give us some insights on that, kind of your history and the current exposure you have.
Okay, so in my career, which is, 30 years or so, definitely by far the best precious metals market that I've ever seen. We had, early 2000s was good, or like the highs into, what was it, 2011, but that was more kind of a flash in the pan type of movie. You had such a swift reversal of those moves, especially in silver, that was not as sustainable looking as it seems to be now. Now we've had such a huge run that I don't think, we've doubled. If you look at the price of gold, for example, we've doubled in the last, I guess, just over a year, or maybe a year and a half. We've doubled. I wouldn't say we're necessarily bound to double over the next year and a half again. I wouldn't count on that. Maybe the miners are more set up for that because they haven't had as big of a run versus their relative range, their prior range that gold has had, maybe silver and copper too. But in terms of a trend, this is certainly the strongest trend I've ever seen in my career really across the precious metals space, whether it's gold, silver, or copper, and especially the equities as well. It's the strongest looking trend or move that I've seen. So is it going to be straight up forever? Obviously not. And you have to have an open mind and be able to get out of harm's way when the data suggests it. But right now, I would say it's still very constructive. The signs are very constructive. I would just say feel yourself against, chasing. You'll get opportunities to buy on pullbacks, and I that's what I would focus on as opposed to, I know it's human nature. The more things go up, the more bullish one gets, but I would try to avoid the FOMO, avoid the chasing, and that generally keeps you out of harm's way.
Well, Dana, just one more sector to squeeze in here real quick is your thoughts on the cryptoverse. Bitcoin and Ethereum had a rocking year, have had a pretty big pullback. Where do you think what's the lay of the land here as we wrap up 2025 with Bitcoin and Ethereum?
Yeah, we were constructive on the two of them, about a month ago, looking for a consolidation and then perhaps set up for another up leg. Coinciding with another up leg in most of risk assets like we're seeing in the equity market. That has not unfolded. In fact, we've seen enough technical damage in both Bitcoin and Ethereum where we see a lot more attractive sources for our money out there right now than those two. So we would be, until we can decisively reclaim some technical levels in both of those cryptos, I would be selling into rallies, into resistance. And again, it's not like there's a dearth of attractive options for your money right now. So we're content with spreading around in many of the equity spaces and some of the resource spaces.
All right, Dana, we'll wrap it up here. Thank you so much for taking time with us throughout 2025, and I look forward to chatting with you in 2026 to just hear what your models are telling you. As far as I'm concerned, you have been almost spot on with judging some of these turns in the markets and where the money has rotated to in a wide range of sectors. I always find it very valuable for myself hearing from you on such a regular basis. So everyone, please click the link in the show notes or search the Lyons Share Pro. That's where you can follow along with Dana and his trading strategies and portfolio management. Everyone, stick around. We're going to be right back. And Dana, I hope you have a very happy holidays. Happy New Year. We'll chat with you in 2026.
Sounds great. Happy holidays and happy New Year to you too.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
Hi, I'm Rory Johnston, host of the Oil Groundup podcast. I'm also the founder of Commodity Context and have been an oil market analyst for more than a decade. What I love about the oil industry is that it is both unquestionably essential to our modern life, and the supply, demand, and pricing of this indispensable product is driven by an ever-changing cornucopia of geological, geopolitical, and technological developments. Listen as I speak with experts across the industry to explore everything you've always wanted to know about what's moving the market for black gold. Find the Oil Ground Up podcast on Apple Podcasts, Spotify, and at clearcommodity.net. Brought to you by the Clear Commodity Network, digital news on the physical markets.
Hey everyone, Justin Hune of Uranium Insider here, inviting you to check out the Going Nuclear podcast, co-hosted by yours truly and Trevor Hall and produced by the Clear Commodity Network. Each episode, we dive deep into the uranium sector and the fast-evolving world of nuclear energy and uranium investment. From supply dynamics to policy developments and market trends, we bring you the insights that matter most to energy investors and industry watchers. You can find Going Nuclear on Apple Podcasts, Spotify, and at clearcommodity.net.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report and continuing this show, the trend of talking to some of our favorite generalist investors and getting their lay of the land. To recap 2025 and early 2026, we are wrapping up the show with Rick Bensignor. Rick is the president of Bensignor Investment Strategies, writes the institutional newsletter, Supposedly Irrelevant Factors. That is read by some of the most successful hedge funds in the world. And on the retail and individual side, check out the In the Know Trader website. I'll post a link to that website in the show notes. That's where Rick has two products, a weekly report called the Tactical Trader Report and a daily report called the Daily Tip Sheet. We chat with Rick on a monthly basis to get his outlook on markets, metals, really any sector that is standing out to us or him. And look, Rick, as we've been chatting with you for a number of years now, I keep on thinking that you are able to call these swings in markets and play some trends better than a lot of other people we talk to. So I first want to start off with this whole concept of sentiment within this broad bull market. Yes, I know we can dive into nuanced sectors, but overall, this market, the U.S. indexes have been going simply up for the last couple of years very strongly. And you would think that sentiment would be high. There'd be a party on Wall Street. People would be excited. Doesn't seem to be that way right now. And I know you use behavioral finance in your analysis. How does sentiment that honestly seems a little depressed for how good this market has been, what's your thought on where sentiment stands in this bull market?
Well, first of all, thanks for having me on for this edition, especially because we get to kind of wrap the year, talk about what's coming next. So I appreciate that. Sentiment is the type thing. So there are a variety of different polls on the street that people use as the basis of sentiment. The ones that are most popularly quoted in the media, generally I say, is the AAII poll, which are individual investors. But it's not a poll that I generally put a lot of credence into. I will give individual investors credit this year because they actually did better than the institutions did because they were buyers of the decline, the springtime sell-off of 20% in the S&P. Institutions sold and then also sold the rebound. And that's why many professional money managers are behind benchmarks this year. So this is one of the rare times that retail actually got it right. And maybe they've learned from the past that buying dips, pays instead of selling the whole, which is something retail investors are more notoriously famous for. So they're wisening up over time, and that's a good thing. But in general, the AAII poll to me is, yes, it gauges a collection of the public's thinking, but generally the more important people to be looking at are the professional, institutional, mutual fund and money managers and hedge fund managers. they're the ones who are actually doing the real buying and selling, not the public. And although the public obviously trades, and because trading costs have gone way down, so there's lots of trading at virtually zero commission costs, they're not the ones who are typically pushing stocks higher or lower. We stay away from meme names, but names, Mag-7 names, the top 50 or 100 names in the S&P. It's not the public that's generally doing the pushing. It's the big money managers who come in and buy hundreds of thousands, if not, sometimes millions of shares of this stuff, buying or selling. They're the ones who you really want to get a pulse on. And there are other ways, not generally, the public doesn't have much ability to kind of get a sense of what they're thinking. But because, I talk to a number of institutions across both the mutual fund and hedge fund community, I often have a pretty good sense of what they're thinking when and if they occasionally feel like jumping out a window. And it's funny, over the years, how many times people have said to me, you're not just my strategist, but you're my shrink. And thank you for helping me, kind of see things clearly and not letting their emotions get the best of them, which is what happens to many people, especially when you are responsible for other people's money. It's a tough role, and obviously they get paid handsomely for what they do, but there's a ton of pressure on that. When you get to be a portfolio manager of other people's money, there's a ton of pressure to perform, to hopefully do better than let's just say the S&P does, the broad-based market does. And having myself been in my 45-year career on the street, I was fortunate enough that I stood in the shoes of all three major roles on the market side, not the banking side of the business, but the capital markets on the trading side of the markets to be in, which was one, I was a pit trader for 12 years, trading stock index futures, COMEX gold, COMEX silver, coffee and sugar, and no, actually not coffee, cocoa and sugar. So understanding from the perspective of a trader and the pressures on a trader, I certainly know that avenue very well because it was my life for 12 years. Then I went sell side, went to Morgan Stanley, and within 2 years was made chief strategist, chief market strategist of the firm. And understanding the pressures on a sell side strategist, as well as almost even more importantly, the research analysts, the pressures they have to, if they go overweight a stock that's trading at 100 and they put out a 150 price target, and all of a sudden that stock's trading 70, they're under pressure. And then if the stock's trading 50, they're the ones wanting to, jump out a window also. And it's understanding their role, and when they upgrade and downgrade, that is a key part of the success I've had too, because I understand how to game their pressure and why they make certain decisions when they do. And then the third part is I was on the buy side at Morgan Stanley also for a few years, my last couple of years there. So helping run the whole prop trading book. And that gave me exposure to what it's like to have pressure of managing money. Understanding each one of those three roles and why, how, and when people in those roles often make the decisions they do, and especially the bad decisions they do, is what I think has been a huge edge over my career in being able to help time the turns the way I do, simply because along with that knowledge and understanding of why someone just downgraded a stock that's way beneath where they told people to buy it, is how you can learn how to, along with some very good technical tools that are beyond the scope of most that you find in a textbook on how to be a technician, allows me to buy and sell and help predict where markets are going to turn well before they ever got there. And you guys know, we speak every month, that to come into this year, I had suggested materially reducing exposure at 609 in spiders, which was first hit early December of last year. Market went sideways for 2 months into the February high that got to 613. That's 0.2% above where it suggested to sell. And then we fell 20% into the the April 7th bottom, which I had also called 3 weeks before we ever got there. I said, if spiders get to the low 480s, that's where you want to be a buyer. And the low of the whole move was 481.8. So, we called many turns this year, most notably in the stock market, in the metals markets. Bonds really have done virtually nothing of real material movement this year and has frustrated the fixed income players the most I've seen in many years. They've been kind of twiddling their thumbs this whole year and by and large looking for lower rates and haven't really gotten them. The short end the Fed controls, but they don't control the long end. And if you look at, TNX at 4.15, yeah, it's lower than we were, but it's not material lower. And most fixed income managers were looking for a solid move beneath 4%. And that just didn't happen. So when you look at sentiment and you understand kind of like right now, coming into today, S&P futures were 56% bulls. That's pretty darn neutral, and we're so darn close to all-time highs. Your premise of the question is correct. Was how is it that the market is so blasé when the market's on and or near all-time highs? And I think it's a combination of some having been beaten badly this year, that it's hard for them to be enthusiastic when the market's this high off of the April bottom, and how few people actually expected that to come. Because in April, if you had said that the spiders would be in the upper 600s when it was trading at in the low 480s, you'd be hard pressed to find too many people that would have said at the time, except for the perma bulls. And the perma bulls I don't count, because there's virtually nothing that changes their view. And that, to me, is not generally a terribly helpful thing.
Rick, you're spot on there. If you think back to April, people were saying they were leaving the United States and not coming back, and no one was going to buy the U.S. markets because they were all going to international markets. And the international markets did incredibly well this year as a theme, too, but that's after underperforming for many prior years. Just from a big picture standpoint, though, if you think about it, the last real corrective move we had in the markets was back in 2022. And we had kind of what some would call a bear market because it was down 20%. And it was, a rougher year for investors. But 2023, 2024, and 2025 have all been large annual green candles. What does that setup say to you as far as from a big picture standpoint rolling into 2026 after a couple of years up? Can we sustain that again, or is there any patterns you look for as far as a reversal year?
I'd be more inclined to think that this coming year is going to be a net up year, probably closer to the more standard annualized return of somewhere between 7 and 10%. But it'll be a rocky year. I think there'll be some moves, some decent moves along the way, that it's not just going to be a straight up year. I think you're going to have up and down. And it wouldn't surprise me if at some point also you have the chance of a real recession showing up this coming year. Looking at the S&P and the fact that the top 20 names is close to 40% or 50% of the whole index. Most of us are just looking at the S&P, and the reality is it's only a few stocks. Underneath it all, I think in many places, the consumer is struggling. Car loans are defaulting at the highest rate ever. The younger generation can't afford to buy homes. It's just, a lot of places are tighter than an S&P that's a percent or two from all-time highs suggests. So yes, the economy pushes along, and those who are more well-to-do are loving a stock market and watching our P&Ls grow all the time. but the average person is struggling far more than you would ever know if you were looking at the S&P to judge the health of the economy.
All right, Rick, let's just quickly look back on 2025 then with some of your best trades. Please share with us what trades you hit well last year and maybe any misses that you had, what we could learn from those as well.
Yep. Okay. All right. So let's start, stocks, as I mentioned, bearish to start the year, got the 20% decline, I know we covered, so the 609 sale, we covered half at 540 and the rest in the low 480s, and then projected that the turnaround would actually ultimately get the diamonds, the DIA, so the Dow, even though we did that in spider terms, I came up with a target for the Dow for the diamonds at, what was it, 474. And we're trading in the 480s now. So, we kind of, the outperformance of the market this year to buy and hold, where you had to face a whole 20% decline before you started, turning around making money and then ultimately doing decently at year end, we're up significantly over what the annual return is because we sold out of a very large portion of the portfolio early in the year and then bought it back really well. So certainly in the stock market, we got very good results this year, way above what the S&P is up. What else did we do right? In June, I got clients to buy silver as a pair trade versus gold. So a hedged trade, which made you short gold but long silver. As of today, that pair trade is 50% higher than where we put it on. So you would have made 50%. You made money in silver. You lost a much less amount in gold, being short gold, to the tune of what, again, right now is close to 50% gain. So that's probably the best or second best idea of the year. What else in the macro picture? The dollar, early in the year, I got the dollar wrong. I got the breakout, but I try to remember what piece of it was wrong. And I remember telling people, we got it wrong. Eventually it turned bearish, and then about 2 months ago turned neutral. So that I do think the dollar will ultimately fall, the dollar index will ultimately fall to 95 or lower as the Fed keeps lowering rates. And when the president puts in a new Fed chair, they'll probably lower rates quickly. So I do think the dollar's probably headed still lower ultimately, but I'm in the neutral to, right now I'd say neutral to slightly bearish, but nothing more than that. I'd say those are probably the big ones of the year. I've been telling people stay away from oil all year. And that's kind of it for for the big calls. The thing is, most people have the bulk of their money in stocks, and we got that very right. And the metals market I have more exposure to metals, both bullion and gold miners, than I've ever had, and I've had them for years, but I added multiple times.
Well, Rick, just on that note with the metals, obviously we have a lot of listeners focused on gold and silver and copper and the commodities complex. It has been a wild year in gold and silver and the related equities, and one of the best years on record. Also, one of the top performing sectors this year. And we've heard from a lot of generalists that they also have the highest weighting they've ever had because they're usually spread across many sectors. As we roll out the carpet for 2026 and we say, hey, what a great year. How are you looking at the precious metals complex as we go from 2025 into 2026 in the here and now?
I'm generally still bullish the metals. It's not so easy to play them at this point. The last thing I did on the bullish side was in the November sell-off. I bought more SLV, so the silver ETF in like at 43.5, 44, and I kicked some of it out this week at 56 and change, and that's already is proving not to be a good sale. But I still have half of that purchase, plus I've been long SLV since I think 2022, the price of 22 from years ago. I always had a thing for silver. When I was a a college student. I happened to be studying in London in 1980 when silver peaked at $50 an ounce. And I remember walking into, I think it was a bank like Sharps Pixley or something, or I don't know what bank it was, but I literally bought some bars of silver and have just always stored them. Since then, I don't know, it just had some fascination with silver. And years ago, I bought SLV and I didn't buy it well. I bought it in 2011 after it had peaked and sold well down, but it still probably sold off 30% beneath where I had bought it. But I just had a feeling over time it makes sense to own silver. And it's finally paid off. I can't say it's been a great long-term investment because I've held it so many years to finally now, make 2.5 times on my money. Would have been much better other places. But it's been a hedge, and if you look at gold since the year 2000, it's performed in line with the S&P. I mean, in the last couple of decades, it's certainly been a good investment, but over the last 50 years, not necessarily. And when I think about the metals for this coming year, as long as the Fed is in cutting mode, and I think they will be, and certainly that's what Trump wants, and he's going to pick whichever Kevin he picks, Warsh or Hassett, you kind of get a pretty good sense that they're going to be in line with his thinking, and that's generally a good thing for the metals. It's not a one-to-one thing, but if we're going to see lower interest rates, I think you still want to be looking for pullbacks to buy metals. And if I had to take a guess now, where would I want to buy gold? It's probably, I don't know, 3850 or something like that. Now we're almost at 4400. I don't know if we're going to get there, but right now that's kind of the area I would think about. Otherwise, I'm just holding what I have.
Rick, I'm curious, and I want you to put back on that kind of commodities trader hat when you were back as a commodities trader. What we've seen this year, I think especially, has been governments warming more up to commodities, especially mining and metals. And investors clearly have taken note because, yes, gold and silver have done well, but also copper, which is a large market. Copper is doing quite well. Outside of energy, old school oil, I feel like metals and mining are more on people's radar. What's your kind of history and your assessment of, have we seen a shift more broadly in the markets favoring metals and commodities?
I think we have. I can think back to the year 2000 where you'd hear a radio advertisement of somebody, hawking gold and hawking silver, but they also did it during all the bad times. They're just, they're salespeople. The difference is over time is that more and more people are concerned about fiat currencies, the value of, paper money, governments just printing when they need to, and the inflationary effects of that. And when the crypto space kind of came along, and let's say in the last 10 years, it's, really developed. People are looking for alternative ways to have some safety for their money. And the metals have, historically provided that. You haven't luckily yet needed it as an American. We're not like Argentina or Greece or places that, have just seen currencies completely collapse. But I think there's more and more of a willingness of the general public to have what was traditionally, people would say you got to have at least 3% of your portfolio in gold, simply as a hedge. Well, somebody a few months ago, I forget, one of the big name guys on the street, I just can't remember which person it was, said, you got to have 25% in gold. And to me, telling people that when gold is first as high as it's gotten, to first say it then, is either a guy just talking his book and trying to get others to buy higher so he can sell into it. It's kind of late in the game to go tell people at $4,000 an ounce to buy gold, but there is certainly a willingness. Governments, central banks across the globe are buying more and more of the gold production and what's available. And so, yeah, I do think there's been a shift in the willingness to look at alternative assets, and especially some of the hard assets. And you could put crypto into that space as something that is intended to hold value regardless of the dollar or some other, foreign currency.
Yeah, Rick, I think that was actually Jeffrey Gundlach that was at Double Line Capital that said 25, 25, 25, 25. But then we also had Morgan Stanley this year come out and change their model for financial planning from the traditional 60-40 to the 60-20-20. And this plays into two themes you've discussed, that the bond market not acting like a hedge along with some of the other sectors are during tough times, but not performing well really either direction, kind of being stagnant. And so that 20% allocation to what they're calling alternative assets has picked up things like, gold and silver, the precious metals. It's picked up some kind of non-correlated assets, but it also has picked up the cryptoverse as another area. Bitcoin and Ethereum is the general trend. But Bitcoin and Ethereum have had a wild year too. They did hit all-time highs earlier in the year, but they've also had a pretty bad sell-off. How are you looking at the crypto side of things and that concept of having 20% in alternative assets?
I don't mind having, I was a late adopter to Bitcoin. So I think I first started buying when it was, I think 60 grand or something like that. So, nothing close to where it was just even a few years ago, where what I think when futures started trading in 2000, what was it, maybe 2018 or something, it was 15,000. Bitcoin was 15,000. So it went up 4 times before I said, okay, maybe let me go see if I can find a place to be in it. I've traded around a core position, and like many people, not thrilled to see what's happened recently. And it's a crapshoot in many ways because you really don't know how to value it. The crypto bull, well, especially Bitcoin bulls, will tell you it's going to, I've heard anywhere from 250,000 to $1 million, a coin. And if you sell, you're a fool type thing. And meanwhile, we've gone from $127,000 down to recently almost 80,000. That's a big decline percentage-wise, in line with other declines over, Bitcoin's historic basis. But this is not for the faint of heart. So if you buy this thing, you're buying it as a hedge, as I'm sure plenty of people buy it to try to make some money on. But you've got to have, shall I say, cojones to play, this thing, because 30% moves against you are nothing. And you could easily have 50% moves against you. It's just part of, now you could have that happen in Tesla, or Apple, but generally people are more willing to deal with that in a true stock in a company that has earnings and valuation than something that is all the greater fool theory that, it has value simply because somebody else is paying more than you are. It's a tougher game. I have money, and I can tell you I have bad purchases they were good for a bit, but now they're not. Some of the other crypto. So I have some Ethereum, I have some Solana, and I have some Ripple. Not a ton. And as a percent of my entire portfolio, the whole thing is probably 2%. But it's not insignificant, but I'm being very frank. I have losses in most of it. It's only Bitcoin that's keeping me profitable on it.
Yeah, it's a wild market, the whole crypto markets, but just interesting to hear it has been adopted fast by some of the retail investors and then more slowly by institutions, but institutions have definitely started to dip their toe in over the last couple of years. Rick, I really want to talk big picture with you about really the biggest sector in the markets, and that is AI moving into 2026. It does feel like, at least now at the end of 2025, the tide has turned for these AI investments. A lot of people talking more pessimistically about them, but quite frankly, you look at the big names leading the AI charge. They're either private or they're the biggest tech names that just throw off mountains of cash with their existing business. How worried are you about AI and the whole trade around that heading into 2026?
So I've addressed this specifically with clients, and what I've said to them is the decline that we're in the midst of, and in some days it's been quite vicious. This is not the AI bubble that they need to be concerned with. It's the next one. So I think there's still another rally coming. I'm not sure if it's peaking in 26, 27, or 2028, but there will be one more significant rally that will be the one that drags every last person into those names. And then to make it equivalent with something, you think about what was like the year 2000 for the tech bubble. March of 2000 is when that whole game ended, and NASDAQ sold off, I think it was 76% over the next couple of years. So comparing historical movements in these bubble kind of conversational areas of the market, this decline was foreseeable, but I've been buying some of the names on dips. Like in November, I was fortunate, bought more stock in a 48-hour period on November 21st and the 22nd than I have ever done. So I caught the bottom on a lot of these, got a decent rally, but a lot of them have also come back to near those November lows. And take a name like CoreWeave, which just took out the November low this week, and then today it's up, I don't know, 12%, something like that. It's flying. That, although the low this week was lower than the low in November 21st, that's a double bottom and flying. So I think that bottom is in. I think we're probably close to the bottoms on what has been a nasty sell-off. Take a name, Palantir. When it had its last earnings report, I think it was trading about 208. The earnings came out, it traded up to about 220 in the aftermarket. And within a week, I think it was trading 180, or even within a day or two. I mean, and fell all the way, maybe into the 150s. It's, there have been some huge percentage moves, but this is not the popping of the AI bubble. This is the one that let out some air. The next time somebody decides to blow up this balloon is the one I'm concerned about. And I'm not concerned as the balloon is being inflated. It's not being there when it pops, because that one will be a nasty, nasty decline. That will make what we just saw the last couple of months pale in comparison to what would come down the road.
Well, Rick, one other sector just to work in before we wrap is the small cap sector. They have been the quote unquote laggard trade for a while, and they finally have had a good, let's say, last month or so, and started playing catch up. And I think some of that ties into the Fed rate cutting cycle and the anticipations that if Trump puts in someone that's very dovish and that they keep cutting rates, that their cost of capital will go down. So we've seen some action across the board and a broadening out in the market. So it's not just the Mag-7. You got a lot of sectors participating, but even the small caps playing along. How are you looking at that more dicey sector of the market, but more volatile sector as well?
Yep. So, this week, IWM made a new all-time high. It's done this a few times where it makes nominal new all-time highs and then fades. It's also the type of thing I've talked about in the past. But the thing is, where it sold off to in the, I guess, the April low, for those of you who know cloud charts, more formally known Ichimoku Kinkuyu in America and the Western world, we call them cloud charts. If you pull up a long-term monthly cloud chart, the low in April was the bottom of the cloud, just like the lows in 2023 were the bottom of the cloud. It came all the way back out. It's now on all-time highs. I think over time, this probably gets up to, so it's trading 251. I've got targets at like 310 to 320, and that could take a year or two or more to get there. But I think in general, they're okay. It's just a dicier, as you say, more speculative part of the market. They like when interest rates go down. You've got a president who's going to help push them down. So I think they're okay, but expect volatility. And if this thing pulled back to, 220, I'd probably be happy to buy 220. I just don't think right now that we're probably going to see that. Even the low in, November's low was 220, roughly 229. Even that feels like a decent low because that was a spike low that ended up closing on the high of the month. So even like in candle terms, I think that low is probably going to hold for now. So in general, I think small caps will do okay, mostly because of lower rates, and they've been underappreciated for a while, so they're playing catch up also. And people are, there's a point to where paying for the large cap and especially the Mag-7 type of names, even if it's not officially a Mag-7 name, but the Broadcoms and, well, Oracle's gotten whacked. So other than today's big advance, there's some opportunity there to, I think, come in and some of the beaten down Mag-7 related names, even if they're not officially a Mag-7 name. The Mag-7 themselves, they'll do okay, but I think they're largely spent. So I don't mind looking at second and third tier Mag-7 types of names. Let's call it the top 50 names in the S&P, but not necessarily the top 10.
I feel like this year was all about a catch-up trade, especially at the end of the year. And hey, into next year, you've given us a lot to consider here, Rick. It's been great having you on the show throughout this year. I look forward to chatting with you in 2026. And for everyone listening, I highly recommend checking out that In the Know Trader website and signing up for either that weekly report, the Tactical Trader report, or that daily report called the Daily Tip Sheet to keep you abreast of what's going on in these markets, especially if you're an active trader and aiming to beat these markets and also be well diversified. Rick, thank you so much for your time. Happy holidays. Happy New Year. We'll chat with you in 2026. And everyone who listened this weekend, thanks for spending some time with us this weekend. Very happy holidays and Merry Christmas to all of you. And we will be back with you in the new year.
The very same to you guys, too. Thanks for having me on. Happy and healthy to everyone.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.